Good afternoon, everyone. Welcome to this rundown for global stocks for the Easter weekend. I'm going to keep this one a bit shorter this time, and there hasn't really been that much change in the markets with a shortened week just gone and another one in front of us. So let's get on and have a quick look at what transpired last week. American stocks were down 14 points on the week with a bit of a pullback on the last two trading sessions of the week on Wednesday and Thursday night. So it didn't really tell us a great deal. As we'll see from the chart, the index is holding up above the 200-day moving average, but the resistance level at around the 2050 mark is still in place at this point in time. The correlation with oil still continues to influence stocks very heavily, and we saw on Thursday and indeed on Wednesday night too, oil pulled back a little bit, and stocks came back almost by by the same amount. I think a further retracement in stocks is now highly likely because oil is looking pretty shaky, both fundamentally and technically, and we'll get to that shortly. And given that there's been such a complete 100% correlation between the price of oil and stocks over the last 6 months or so, then I think that's important. We need to take notice of that. The Aussie dollar finished above 75 cents, but it was trading at one stage at about 76.5. With the US dollar rally over the last couple of days, the Aussie got down under 75, got down to about 74.8, but then firmed up a little bit on Thursday night. But I still think it's much higher than it should be and much higher than it will be over the duration of this year. The ASX 200 was down by 100 points on the week with a fair amount of damage done on Thursday. So the index, which had popped its head above a reasonably long-term trading range, is now back into that trading range, and it was really pressure on the local banks in particular, but also the miners that did the damage. But an increased provision for bad debt from ANZ and also a bit of an increase in provisioning from Westpac as well really fired up some selling in the banks, and a lot of it's coming from overseas. There is this fixation that the Australian housing market is going to encounter some significant difficulties, and that will flow through to the banks. I don't believe any kind of reasonable examination of how the banks sit that really holds water, but nevertheless it is what it is, and overseas hedge funds are actively shorting our banks, that's for sure. So our market's just going to continue to be pushed around by overseas funds, and that's pretty much the long and the short of it. So let's take a look at some charts. We'll start with the S&P, first of all on the big picture monthly chart, and you can see that the RSI has rolled over. So this is a very big picture look. This is about nearly 20 years view. But you can see that the market does run in significant cycles. We got significantly overbought prior to 2000, and even though the price was increasing leading into 2000, the RSI was falling, so that divergence which took nearly 2 years to play out, so these things don't necessarily change quickly, it eventually did play out, and all that excess was removed from the market. We got down to being oversold, both on the RSI and on the MACD. We then went into 2008, pardon me, again. You can see some divergence here. The market was continuing to rise, the RSI losing momentum, started to fall, and then the MACD followed as well. And then, of course, we run forward to today, and we can see that the MACD started turning down in August of last year. The RSI really earlier than that, really the RSI started declining early in 2015. So it's been in decline for about a year. And there's definitely a change of character in that market. You can see that the blue moving average line is about to cross the red one, which it doesn't do very often. So the blue line is a 10-month moving average, and the red line is just check that, is a 20-month moving average. And so we do have a crossover there now. Let's just zoom in on the daily chart. You can see we've got a downsloping resistance line. The index hasn't really been able to break clear of it. We did rebound a bit on Thursday night, so that's at least a little bit encouraging. But I'm looking at the potential for either around the 1980 mark, or what is more likely is around the 1950 mark for a bit of a retracement. And depending on how that retracement plays out, will tell us a bit about what happens over the next few months. Turning now to the Aussie market, you can see that we've got this big trend channel that's been really in play now since April last year, so nearly a year. Had a little look above it for a couple of weeks, but closed firmly back inside that trading range. And it's quite possible, if things get a bit nasty overseas, that we could see new lows formed in the Australian market down below 4,700. Certainly the way our banks are being sold at the moment, that is a distinct possibility. Just while I'm here, I'll take a look at gold. So this is gold. You can see it's clearly broken out of a very big picture wedge. We're getting a bit of a retracement to that breakout, which is exactly what you'd expect to see. Well, let's zero in now on a daily chart, and we have broken, as I explained last week. One of two things were likely to happen. We would either get an ABC correction to the downside. There's the A leg. This would be the B leg, and then we get the C leg to the downside. So that was the most likely pattern. And we've got the 38.2% retracement here at just under 2,000, and also these peaks from October. So that would be a logical place for the market to go. Again, you can see we had divergence here. The gold price kept rising from February of 2016 through to March, but the RSI was certainly going the other way, and eventually the market has rolled over. Now, I thought there was a possibility that we may remain within this, just a sideways consolidation, but as you can see, we broke that 1230 level on Wednesday night, broke it quite emphatically. So I think we're probably going to get a bit more downside at gold yet. Just looking at gold stocks, this is the HUI index. You can see very clearly the 200-day moving average. The price has been above it now for a number of weeks since early February. So we're heading now towards 6 or 7 weeks. It's been above there, which is pretty definitive. The 50-day moving average now has clearly cut it and is heading upwards. The price remains quite strongly above the 50-day moving average. So they're pretty good signs. And gold stocks, there was a bit of a sell-off. A lot of stocks were down 6, 7, 8% on Wednesday night, but they actually stabilised and rose on Thursday night, where the price of gold was actually pretty steady. So good signs in the gold market. So gold, $37 lower for the week. But the gold stocks, as I said, pretty reluctant to retrace very far. But what I have noticed is that there's a enormously strong or a big difference between the best performing gold stocks and the worst performing gold stocks, both fundamentally and technically. This is a market where you really want to focus on the best ones. Turning now to copper, was steady at 226, so it went up with the US dollar, went down, and then reversed and came back down again when the US dollar went up. So just trading in line with the currency. But it's really crude oil that I think is the thing to watch at the moment. Crude oil went above 40, 41, and then came back down again with renewed strength. The US inventory data that came out on Thursday was at a record level. It's indicating that the storage is running out rapidly in America, so they're not making any headway into getting that inventory level down. They're not really making any headway in getting production back into balance. So I think we're a long, long way from getting either production or inventory back into balance. And crude oil above $40 just doesn't look sustainable to me. The fundamentals support a move down to at least 35 or lower, and certainly the technicals are showing signs of rolling over as well, as we'll see in a minute. So there's a chart over the last 3 months. You can see the strong short covering rally that we've had in oil, and it just seems to now have run out of gas. And you can see we closed below that trend channel for the first time in a number of weeks, and you can see we also took out some short-term lows as well. So I expect to see, and also we're getting some divergence here on the RSI, as you can see. The price of oil rose, but rising at a slower and slower rate, which is what happens, of course, just prior to the price rolling over. So we're seeing that now. So I think oil lower, that should put a downward drag on stocks, and we'll see how the gold market plays out. There's just a bigger picture. That's the 3-year view on crude oil. So it's had a little bit of a blip upwards, but not really very much. There's the spot copper chart. Not much change there. So just to wrap it up, I would expect a near-term pullback over the next few days. Certainly, I think there's a good possibility that'll happen next week. And as I've been indicating now for some time, you really need to work from the extremes of price and sentiment and go the other way. Whether you're a trader or investor, I think trying to be in the market and trying to be active all the time is just not the thing to do. It's just going to be too hard. And if you look at the recent history over the last 6 months, if you just positioned yourself for the significant reversals and just work from there, then you would have done reasonably well. I also, as I've been indicating now for a number of weeks, I wouldn't rely on fundamentals or logic, because in the short term they're pretty much meaningless. This is a market globally that's being driven by computer algorithms, by technical aspects, and you've just got to recognize that that's how it is. There's no point in sticking your hands in your pocket and saying, well, I'm a fundamentalist and I'm going to work on that basis, because just look at what's happened with healthcare stocks over the last 6 or 8 months. Some of them are down to just insane levels of valuation. We also saw the semiconductor stocks, which were terrific businesses, sold off very, very heavily. And I'm talking 30, 40, 50%. So, it's fine to be a fundamentalist, but if the market is operating on technicals, then you've got to factor that in. And the final thing is the signs really are looking pretty good for gold stocks, so I would be prepared for that. And if you don't really know how to play the gold market properly, then please get some assistance, whether it's from me or from someone else. But, this is a market where there's terrific opportunity, but there's also a lot of danger. And, you've got to have traded these kind of markets before to really have much of a chance of making headway. So that's the rundown for this week. For non-members, if you would like some assistance, if you would like to communicate with me, there's my contact details. Always happy to do so. That's it for this rundown. I'd like to wish everyone a extremely safe and say healthy Easter break. See you next week. Cheers.